Quantitative investment concepts provide the analytical framework used to evaluate investment performance, compare alternatives, and measure risk-adjusted returns. Financial planners rely on quantitative analysis to support objective decision-making and develop investment strategies aligned with client goals. These concepts help investors assess historical performance, estimate future outcomes, and understand the relationship between risk and return. Quantitative measures are particularly important because investment decisions involve uncertainty, changing market conditions, and varying economic environments. By applying statistical and mathematical techniques, planners can evaluate portfolio effectiveness, identify strengths and weaknesses, and determine whether investment strategies are likely to support long-term financial objectives. Quantitative analysis forms the foundation of modern portfolio management. One of the most important quantitative concepts is the measurement of investment return. Return represents the gain or loss generated by an investment over a specified period and may consist of income, capital appreciation, or both. Income returns include dividends, interest payments, and distributions, while capital gains result from increases in asset value. Total return combines these components to provide a comprehensive measure of investment performance. Financial planners evaluate returns over different time periods to assess consistency and effectiveness. Comparing returns across investments helps identify opportunities that align with a client's objectives, risk tolerance, and investment horizon while providing a basis for portfolio evaluation. Several methods are used to calculate and analyze investment returns. Holding period return measures the percentage gain or loss earned during a specific investment period. Arithmetic average returns provide a simple average of periodic returns, while geometric average returns account for compounding and often provide a more accurate measure of long-term performance. Dollar-weighted returns incorporate the timing and size of cash flows, making them useful when evaluating actual investor experiences. Time-weighted returns eliminate the effects of external cash flows and are commonly used to evaluate portfolio manager performance. Understanding these calculations allows financial planners to interpret investment results accurately and make meaningful comparisons across strategies. Risk measurement is another essential aspect of quantitative investment analysis. Standard deviation is commonly used to measure volatility by assessing the dispersion of returns around an average value. A higher standard deviation generally indicates greater uncertainty and risk. Variance provides a related measure of return dispersion, while beta measures a security's sensitivity to movements in the overall market. Beta values greater than 1 indicate greater volatility than the market, while values below 1 suggest lower sensitivity. Financial planners use these metrics to evaluate portfolio risk characteristics and ensure that investment strategies remain consistent with client objectives and risk tolerance levels. Correlation and covariance are important tools for understanding relationships among investments within a portfolio. Correlation measures the degree to which two investments move together, ranging from positive correlation to negative correlation. Investments with low or negative correlations may help reduce overall portfolio volatility when combined. Covariance provides a statistical measure of how asset returns vary relative to one another. These concepts form the basis for diversification strategies because portfolio risk depends not only on the characteristics of individual investments but also on how those investments interact. Financial planners use correlation analysis to build portfolios that balance return opportunities with effective risk management. Asset allocation refers to the process of distributing investments among major asset classes such as stocks, bonds, cash equivalents, real estate, and alternative investments. It is widely regarded as one of the most important determinants of long-term portfolio performance. Different asset classes exhibit distinct risk and return characteristics and respond differently to changing economic and market conditions. Asset allocation decisions are based on factors including investment objectives, time horizon, liquidity requirements, tax considerations, and risk tolerance. Financial planners develop strategic asset allocation models that reflect client needs and provide a framework for long-term portfolio management and disciplined investment decision-making. Portfolio diversification is a risk management strategy that involves spreading investments across multiple securities, industries, sectors, geographic regions, and asset classes. The objective is to reduce unsystematic risk associated with individual investments while maintaining exposure to potential growth opportunities. Diversification works because different investments often respond differently to economic events and market conditions. Poor performance in one area may be offset by stronger results in another. Although diversification cannot eliminate systematic market risk, it can significantly reduce company-specific and sector-specific risks. Financial planners emphasize diversification because it improves portfolio efficiency and helps create more stable long-term investment outcomes. Quantitative investment concepts, measures of return, asset allocation, and portfolio diversification are closely interconnected components of successful investment management. Return calculations provide insight into performance, risk metrics quantify uncertainty, and correlation analysis supports diversification decisions. Asset allocation establishes the portfolio's overall structure, while diversification helps manage risk within that framework. Together, these concepts enable financial planners to design portfolios that align with client goals and adapt to changing market environments. Rather than focusing solely on maximizing returns, effective portfolio management seeks an appropriate balance between risk and reward. A disciplined approach based on quantitative analysis enhances decision-making, improves portfolio resilience, and supports long-term wealth accumulation and financial success.